If you want to be a part of the conversation before it happens here on YouTube, click that link in the description to join the free Courtside Financial Discord. What's going on, everyone? Welcome to Weekend Recap on the Courtside Financial Podcast, a segment where we bring you a compilation of everything that went down throughout the week from a stories perspective. Before we get into this video, make sure you hit the like button, make sure you hit the subscribe button, and click the notification bell icon so you don't miss out on any content that's coming in the future. So, in short, NIO's journey has been nothing short of remarkable, but it goes without saying that they have been experiencing some challenges. The burden seems so heavy that it's hard to breathe. Founder Lee Bin is making bold moves to navigate these choppy waters. Today's episode is all about understanding these decisions, the implications, and what lies ahead for the company. So let's get right into it. NIO has announced two significant decisions that have taken many by surprise. The first is a round of layoffs, which is obviously never easy for a company. But Lee Bin made it clear that this is a necessary step to optimize their organizational structure and really lay down the right foundation for the company to be more efficient moving forward into the future. Approximately 10% of jobs at NIO will be eliminated. That's huge, and this will leave around 2,700 employees left with the company. The second decision is all about abandoning plans to build factories in the US. NIO has been facing a lot of financial challenges, as Lee Bin himself had stated. This year's comprehensive performance is still far from the expected target. But here's the big question: are these measures enough to get NIO back on track? It seems like NIO's product lineup might be part of the problem. They have too much diversification around their product lineup, which can make resource allocation less than optimal. Aside from the ES6, the sales of the other models are just average. The variety that NIO offers may be actually counterproductive and working against them. And so NIO needs to address this issue if they want to compete effectively in the market. After all, their job is to sell more cars and continue to boost sales over time. Moreover, we all know that NIO's ventured into several other projects like insurance and mobile phones. While the idea is to create a seamless experience for NIO car owners, the high cost and limited demand raise questions about the wisdom of these moves. Lee Bin once said, if you don't have a mobile phone, it's the equivalent of having your car keys in someone else's hand. It's very clear that NIO has a lot on their plate, and not all of it is profitable. The mobile phone business, for example, appears to be another cash-burning business that might require some reevaluation. In addition to mobile phones, NIO's heavy investment into battery swapping is another point of contention for the critics. NIO's built their business in such a way that the battery swapping model is crucial to what they're trying to accomplish, and it's almost a little bit too late to get rid of it. These stations come with a substantial cost, and they too have yet to turn a profit. Whether it's about building mobile phones, offering insurance, or battery swapping to their customers, it's clear that NIO has a mission to build a seamless experience for their customers. However, this comes with a high cost. The challenge is for NIO to strike a balance between finding a seamless experience for their customers and financial stability. Let's set the stage. NIO, a major player in the electric vehicle market, is making some very tough decisions at this time. In an effort to weather the storm, they've opted for a 10% reduction in their workforce. And now, it's not just numbers on paper, it's hitting home in departments like mobile phones and batteries. The stumble? NIO's ambitious venture into self-made batteries led to over a 27% net loss, reaching a formidable over 6 billion yuan in a single quarter. A substantial 3.34 billion was spent on research and development, which kind of just emphasizes the financial strain here. To stop the bleeding, NIO is kind of reevaluating their new car plans and focusing on sales recovery. In this turbulent journey, they're scaling back, optimizing, and adapting to the turbulent winds of the market. But it's not just domestic troubles. NIO is grappling with a two-front battle. The entire electric vehicle market, the domestic market, is experiencing a slowdown. and their overseas forays are yet to experience promising returns. It really is a tough spot to be in. But for a second, let's talk numbers. NIO's net loss for the year expanded by almost 140% year over year, with cumulative losses soaring to 10.79 billion yuan. In the face of adversity, layoffs and business contractions are steps towards reducing expenditures, as they say. But here comes NIO's wild card, the Alps sub-brand. NIO's Alps sub-brand could be their trump card in the 200,000 yuan market. However, the plot thickens as competitors are also flooding the market with their own offerings in this segment. In a world where intelligent driving becomes crucial, can NIO survive at this pace is the question that investors want to know. So everyone stay tuned for the unfolding saga of NIO's odyssey to maintain afloat and, try to be at the top of the EV race. Car companies are entrenched in a multifaceted struggle at this time. They're facing a melee where financial viability and survivability are at stake. This is no longer a story of pure competition. It's a story of existential crises. Bankruptcies, massive layoffs, and a scramble for relevance sweeps through the industry. Tesla, which was once heralded as the pioneer of the EV industry, is now facing production troubles. Their latest financial report reveals a challenging scenario that they find themselves in. They missed revenue and earnings per share expectations for the first time in years. The Cybertruck, which many thought was a promising addition to Tesla's catalog, faces a bottleneck in production due to stark differences from the other models in their lineup. As a result, this is leading to an impending crisis here for Tesla. Despite these hurdles, Tesla maintains its commitment to innovation. With investments exceeding market expectations, their commitment to research and development is substantial. Notably, a significant chunk of this money is directed towards artificial intelligence for Tesla. This emphasizes the need for larger scale models in the evolution of their car making platforms. But the narrative extends beyond Tesla. Take a look at NIO and XPeng, for example. These two companies are not excluded from the struggles faced throughout the market. They're grappling with their own challenges as well. NIO's layoffs reflect the automotive market's weak performance in the near term. This is obviously raising questions about NIO's ability to sustain its long-term diversified ventures. Meanwhile, XPeng, despite their recent backings, faces a slump in sales and safety concern. This is indicative of broader industry challenges for the company. Yet, amidst the downturns that we're seeing here, Li Auto is emerging as the beacon of success. They're achieving profitability in a landscape marred by losses. Li Auto defies the industry with 3 consecutive quarters of profit. However, they are still challenged in this climate as well because they're facing the pressures of the shift to pure electric vehicles. Obviously, they're in a position of power with profitability here because they are making hybrid vehicles. But the industry wants to shift to pure electric vehicles eventually. We talked about WM Motors on this channel before. We talked about how WM Motors, who was once one of these top players, has recently filed for bankruptcy. Their story is a cautionary tale, and I did a whole episode on this. A rush focused on the B-end market and autonomous driving technologies being outsourced culminated to lead this company into bankruptcy, along with how they handled their recalls as well. As such a small company, a recall can really be crippling for you if you don't handle it the right way. We talked about this. If you want to check it out, go check out that video. It's on the channel. It's one of these episodes. But moving on, Huawei's strategic entrance into the automotive scene raises questions. Questions about industry partnerships and the shifting landscape. The battleground extends into intelligent driving, which is the next frontier of the automobile industry. As new energy vehicles shift towards autonomy, the battleground intensifies. Giants like Tesla, NIO, BYD, XPeng all fight for supremacy in this market. Huawei hopes to utilize a lot of the technology that they already have to kind of be a leader in this sector. In this intense competition that we're seeing here, we witness not just a race for innovation, but also a race for survival. The new energy automobile industry stands at a precipice and the road ahead is uncertain. The casualties are mounting and the implications for the industry's future are profound. That concludes this episode of the Courtside Financial Podcast. I wanted to give you guys an overview of what's going on in the industry because it's not looking really pretty right now, coupled with the fact that the stock market, is not doing so well either. So Tesla's third quarter performance unveiled a concerning narrative. Revenue rose, yet it fell short of expectations. The profit margins, which were once robust, are on a downward trajectory, caught up in the winds of this industry price war that we're seeing right now. But beyond the numbers lies a different challenge. Geopolitical tensions are casting a shadow over Tesla's ambitions. The ongoing US-China trade conflicts and Europe's entanglements in its own disputes pose substantial threats to Tesla's strategic moves. Elon Musk, undeterred, aims to deliver 1.8 million vehicles this year alone. However, the landscape is shifting and the profitability of the once promising Cybertruck doesn't look so great right now. The expectation is a lengthy 12 to 18 months for a projected return. Beast Finance draws attention to additional obstacles. Potential interest rate hikes could tighten the already difficult path for consumers, affecting Tesla's sales. Moreover, geopolitical risks loom large, affecting Tesla's ability to navigate a global supply chain. The intricate web extends to Tesla's advanced project. Critical components sourced from Taiwan face export restrictions, jeopardizing the strides that Tesla's been making in artificial intelligence. This is particularly crucial in the Chinese market. As Tesla stock dips, questions arise about its lofty valuation. It's trading more at 60 times forward earnings right now. The company's ability or capacity to weather these multifaceted challenges is coming into a sharp focus. In conclusion, the once favored darling of investors is now facing so many challenges. Rising interest rates, fierce competition, and geopolitical tensions are all weighing down on Tesla at this moment in time. And these things are cause for concern. They obviously, in my opinion, demand reevaluation of Tesla's trajectory. This has been a sobering episode of Courtside Financial. I know there's a camp of people out there who have viewed Tesla as a guaranteed investment. In these uncertain times, strategic prudence is paramount. That's going to be it for this episode of Week in Recap for the Courtside Financial Podcast. If you found any of this information valuable, make sure you hit the like button, make sure you hit the subscribe button, and definitely leave a comment down below. Genuinely interested in hearing what you guys think about these this new style of videos that we're doing. Anyways, that's going to be it. I'll catch you guys next time.